Good morning, traders. This is Evelyn from Astra Montis, and I'm here to bring you the latest insights for the week of July 29th to August 2nd, 2024. Let's dive into what to expect in the upcoming week. This week unfolds against a backdrop of intense global economic scrutiny and anticipation, particularly as key central banks prepare for pivotal meetings that may shape the financial landscape. The Bank of Japan's upcoming decision on tapering bond purchases and potential rate hikes is drawing significant attention, while the Federal Reserve is expected to maintain its current stance following a robust Q to GDP report. As investors closely monitor the outcomes of these meetings, the focus will also be on inflation trends and labor market data that could influence monetary policy in the U.S. and beyond. The Bank of Japan's July 30th to 31st meeting is set to attract attention as policymakers discuss reducing bond purchases, potentially having the current 6 trillion yen monthly figure. Governor Ueda's tenure has been marked by speculation on rate hikes and hints of bond tapering, keeping the BOJ in the headlines. However, uncertainty remains about the timing of a rate hike, with a 10 basis point increase only about two-thirds priced in by investors. Meanwhile, the Federal Reserve is expected to hold rates steady following a strong Q to GDP reading, despite mild signs of an economic slowdown. The resilient labor market supports maintaining current rates, especially with the July non-farm payrolls report due soon. The Fed remains cautious about committing to rate cuts, with recent data suggesting inflation is moving towards the 2% target. The Bank of Japan meets on July 30th to 31st to discuss tapering bond purchases, possibly having the current 6 trillion yen monthly figure, while speculation on rate hikes persists. A 10 basis point increase is only about two-thirds priced in, leaving room for disappointment if rates stay unchanged. The Federal Reserve is also expected to hold rates steady after a strong Q to GDP reading. The resilient U.S. economy and labor market support maintaining current rates. Fed officials are confident about achieving the 2% inflation target, suggesting no immediate rate cuts while awaiting further economic data. The Federal Reserve is expected to hold rates steady after a stronger than expected Q to GDP reading, while inflation remains a concern. Recent comments from Fed officials indicate growing confidence that the 2% target is within reach. However, they are likely to avoid committing to a specific timeframe for rate cuts until more data is available. With the July non-farm payrolls report due soon, Chair Powell is expected to avoid pre-committing to any rate cuts. The U.S. economy is projected to have added 185,000 jobs in June, maintaining the unemployment rate at 4.1%, with stable wage growth. This cautious approach allows the Fed to keep options open based on incoming data. The Federal Reserve is expected to hold rates steady after a strong Q to GDP reading, with officials showing cautious confidence in reaching the 2% inflation target. With the July non-farm payrolls report on the horizon, Chair Powell is likely to avoid pre-committing to rate cuts, allowing flexibility based on incoming data. Meanwhile, the Bank of England faces a tight vote on Thursday. UK inflation has recently hit the 2% target, but concerns about high services inflation and slow wage growth persist. Market opinion is splitting on an August rate cut, but subtle hints suggest a 25 BPS reduction is possible, as policymakers believe rates may not need to remain at 5% to maintain restrictive policy. The Eurozone's economic rebound has hit a snag, with Q to GDP expected to show a modest 0.3% Q-to-Q growth, raising the annual rate to 0.6%. More immediate attention will be on July's PMI surveys, which have deteriorated further, influencing the European Central Bank's stance on a potential rate cut in September. Investors will closely watch Wednesday's flash CPI estimates, anticipating a further decline to 2.3% YoY, edging closer to the ECB's 2% target. Meanwhile, the Federal Reserve is expected to hold rates steady after a strong Q to GDP reading, with officials cautiously optimistic about achieving the 2% inflation target. With the July non-farm payrolls report due soon, Chair Powell is likely to avoid pre-committing to rate cuts, maintaining flexibility based on upcoming data. Australia's inflation has been rising, reaching 4.0% YY in May, diverging from global trends. The Reserve Bank of Australia has been cautious about rate hikes, but upcoming quarterly CPI data may prompt further tightening at the August 6th meeting. A higher-than-expected CPI could also strengthen the Australian dollar, which has suffered in recent market downturns. In the U.S., the Federal Reserve is set to maintain current rates after a strong Q to GDP report, with officials optimistic about nearing the 2% inflation target. Chair Powell is likely to keep options open, awaiting the July non-farm payrolls report before making any commitments on future rate cuts. This week has been marked by significant economic developments worldwide, with the impending decisions from central banks like the Fed and Deutsche taking center stage. The potential for rate adjustments amidst varying inflationary pressures and labor market conditions highlights the ongoing uncertainties facing global economies. As we await crucial data releases and policy announcements, the financial landscape remains dynamic and challenging. Stay informed as we continue to track these developments for their implications on markets and investor strategies moving forward. To conclude, as we navigate through this week's trading landscape, it's essential to closely monitor these significant updates. We appreciate your confidence in our insights and wish you prosperous trading in the days ahead.